Hello again and welcome to Module 23 of the Series 65-66 series from Series 7 Specialists. I'm Dan Mars, I'm your instructor, and we'll just go ahead and pick back up where we were. They're just a couple of lines down on page 35 of the outline, starting to talk about real estate limited partnerships, all right? Or direct participation programs, or DPPs. Sometimes you'll see that any of those terms, just use them kind of interchangeably on your test because they're all direct business ownership. So those limited partnerships are going to report on a Form K-1. Now if we back up just a little bit, we were talking about REITs, real estate investment trusts, and REITs, they'll report on a 1099. There's no place to put a loss on a 1099. Therefore, if you want to take a loss on current operations, say from depreciation, then you have to have something that's going to report on a K-1, because there's just no place to put it on a 1099. It can't get through to your investors. So if you want that loss, like I say, use a real estate limited partnership. Now, these real estate limited partnerships or direct participation programs, they can invest in a variety of different property types, risk-reward parameters to match. And again, the easiest way to do this, because you just need a good working understanding of this, all right, is that just think about a single property, all right? What are the risk-reward parameters that go with that particular piece of property? So like for instance, at first we have new construction. Well, you know what? New construction, we're just taking just a chunk of dirt, and all of a sudden we're adding significant value to that dirt by building an office building, we're building an apartment complex, we're building something on it. And just by virtue of the fact that there used to be just nothing and now there's something, that adds value. And so what are we wanting to do? We're wanting to claim that value, to get that capital gain, that capital appreciation from our efforts in doing all the site prep and the plumbing and the and this and that and whatnot. You've got all the stuff that goes along with building and adding value to that plot of land. Now, another thing about it is that everything in this thing is going to be new. And so therefore everything ought to be covered by warranty if it doesn't work. So your maintenance costs, your repair costs, replacement costs should be much lower than in existing properties. Okay. On the other hand, are you going to be, think of a shopping center. Are shopping centers necessarily fully leased the day that they open their door? Probably not. It may be. But you run that risk. Apartment buildings the same way. That's why they'll run specials when they open up, grand opening specials, because they want to get that cash flow coming in. So, and by the way, how long did it take it to get to the point where they could get cash flow? Remember, this is new construction. We started with dirt. So they've got all that work that has to be done. So just, again, think about that single property. Those are going to be kind of amalgamated into a real estate direct participation program. So with new construction, like I say, you're looking for the capital appreciation plus then some cash flow. Have certain advantages and disadvantages that go along with it. Do you have your financing yet, by the way? Oh, you don't? Are you going to be able to get it at favorable rates? There's a risk that you have with new construction. All these things, just think about it. Okay, they all go as if it were a single property. An existing building, you know what it is. You know where it is. You know that, for instance, if it's an apartment complex, you know how full it is. You know what the lease rates are. You know what the turnover is. You know how much it takes to maintain the thing because you maintained it last year. On the other hand, the stuff is older, and so as it gets older, it's going to start breaking more and more, need to be replaced more and more. Oh, and by the way, what about those grand opening specials? Were they below the market on a long-term lease? A lot of times that happens, especially with commercial properties. Okay? So you may be locked into those because the lease is going to outlive the sale. All right. So like I said, it's just all the things that are going to go with the existing single building, like the current cash flow. You know what it's going to be. Okay? But you don't get that pop because the building's already there. as far as the capital appreciation is concerned. So like I say, just apply the one to the programs. That's going to be it. Raw land, there's only one reason that I would invest in raw land, and that's because I want, over the long term, capital appreciation. One of these days, they're going to put the sewer line all the way out to my property, and then there's going to be a convenience store that'll pay 10 times what I paid, and yeah, that's it. In the meantime, what have you got? You have no cash flow, because I mean, even if you lease it to a farmer, you still got to pay taxes and you still got to pay insurance on it, because some kid's going to go rabbit hunting, step in a hole and going to break his ankle. You're going to have a lawsuit. You got to have that insurance, okay? So no cash flow. In fact, negative cash flow in most cases. And like I say, it just capital appreciation. It's the only reason you'd invest in a raw land partnership. Government-assisted housing. Now, government-assisted housing, you're going to have cash flow that is reasonably secure. In fact, there are a lot of folks that invest in individual government-subsidized housing units that they don't care if the people actually pay their share. They'll just take what the government gives, and that's good. So that's going to be just regular cash flow. But you have a certain pride of ownership if you own something. And if you're using your money to rent something, it may be a little bit lower, but it's still there. If you're using somebody else's money to rent something, what difference does it make? And so you're going to have high maintenance expenses. You're going to have to follow government rules and regulations. Okay? Your capital appreciation potential is going to be next to nil because of those same factors. But like I say, you're going to have dependable cash flow. You also have resort properties and condominiums. Remember that if you do this, you can actually use it for your own personal use. A maximum of 14 days or 10% of the amount of time that it's rented, whichever's greater, and still have an investment property. Okay, that's one of the reasons you do it. But you've got other things that come into play when you look at resort, vacation areas, what have you. Yes, you have you have the cash flow. Yes, you have the ability to use it yourself. But a lot of these things are in areas that are prone to hurricanes, let's say. And so you have that risk. What happens if a hurricane does go through? A buddy of mine said, he was talking to somebody, said, hey, I'll let you in on the ground floor of a resort condo. He said, and I looked at it, and that's all there was the ground floor, because everything else has been blown away. You got that kind of risk. All right? And probably the classic case is Las Vegas. I mean, why is Las Vegas Las Vegas? It's Las Vegas because it's the ground zero of one-upsmanship. I mean, somebody built something in Las Vegas that was really, really nice. And then somebody else came along and said, nice isn't nice enough. We'll build it extra special. And then special, that's not good enough. We'll build it not only special, but cool. Not only cool, but outstanding. Not outstanding, but amazing. Not amazing. You get the idea. It just keeps... And what happened to that first one that was really, really nice? Nobody wants to go there anymore. Okay? You have those kind of risks with resort areas. So, like I said, just think of the individual property, expand it out to the partnership, and those are the risks that you have. In addition to, we've just been through some of these, the possibility of appreciation, tax benefits. Where you're going to see that is on historical restorations, mostly possibility of cash flow. Now, they're highly illiquid. Highly illiquid. You can take just about any kind of business operation and syndicate it into a partnership or some type of a joint venture, something like that, and sell interests in it. Okay? The thing about it is that there's no market for these things, typically, in the secondary market at all. I saw one that it was a business type partnership where the general partners went in and bought certain types of business, managed a portfolio of these types of businesses, and they were good. They were really, really good. And so about 2 years after the partnership was formed, these things were selling at about 3 times what they originally went public at. No, excuse me, that was the net asset value on them. The estimated value of them was about 3 times their original value. What they were going for was actually even a little bit less than the original price, because the market is so illiquid. Now, remember when we said spreads and efficient markets? And as your market gets more and more activity, gets more and more efficient, and those spreads get tighter and tighter? This was exactly the opposite. No marketplace, so your spreads were they were out forever. Very illiquid. If you have to get out of one of these things early, you're gonna get stung. I'll just tell you that right now. It's the way the marketplace works. So, look at suitability. Can the person tie up the money for? How long is this thing gonna last? Check your prospectus on the thing. It's gonna last 8, 9 years, 10 years. Can they put that money in for 10 years? Are you certain? If not, it's going to be unsuitable. All right, because of the illiquidity of the marketplace. Often very high risk, and they are concentrated investments. And so you have, like I said, with that one is that particular type of business. If that particular type of business had tanked, yeah, there you go. You're a direct owner in those types of businesses. All right, so in any event, like I say, often high risk and often concentrated. The information that has to be on confirmations. At this point, we have to take kind of a step back from individual products and look at the broader view of actually selling those products and what we have to do inside the account in which we buy those products. So we have to have a full itemization of all the transaction details, such what is it, how much was it bought or sold? We have to have the capacity in which the firm acted. Did we act as an agent on your behalf, like we went out to the New York Stock Exchange? Or did we act as a principal and take something out of our own inventory? All right, the market making status of the firm, if it's applicable, and disclosure of control, if any, like on municipal bonds. If one of our principals is on the board of the authority for which we're selling the bonds, then that needs to be disclosed. Any conflicts of interest. You're going to have conflicts of interest. It's going to happen. Just disclose them properly. It's, like I say, make it a habit to disclose. All right, and then it has to be sent out by the completion of the trade. So that's on our confirmations. All right, so now we shift over to another product, and that product is variable annuities. All right, variable annuities are an insurance product. They are securities. When we talked about the Uniform Securities Act, we said that fixed annuities are not securities. Variable annuities, that word variable, it's a dead giveaway that it is. All right. And what we have is we have a separate account inside of this insurance product, which allows for flexibility of investments choices by the policy holder. All right. So here I'd like to just kind of draw this out. Okay. Now, basically, what we have is that we have, here's an investor, has some money, and puts it into a variable annuity, okay? That annuity, the first thing that annuity does is that it provides a protective bubble for his money. So let's go ahead and get his money inside of here. There we go. And taxes, they can look at it, but by law, they're going to bounce off on a current basis. All right, so it can't penetrate in there. So what do we do with this is that we actually create this little pot and we put the guy's name on it. So there's Bob, and Bob puts his money into Bob's separate account. Now if Bob had a fixed annuity, Bob's money would go into a pot that was labeled XYZ Insurance Company. That's the general account. Bob would have no control over what went on there. Okay? And so it would, like I say, it'd be a fixed annuity with a general account. But since it's a variable annuity, he has separate accounts. And his investment choices, once he gets inside that pot, he might have a large cap stock fund. He may have small cap stocks. He may have TOX. There we go. He may have foreign He may have domestic. He may have long-term, short-term, medium-term bonds. You get the idea. He's got a lot of different choices and it can change around. This is looking a whole lot like family mutual funds now, isn't it? It's not, but that's not a bad way to think about it while you're taking the test. Please, please do not sell them that way, all right? It's just all wrong to sell them as mutual funds. They're not. It's a big difference. But we're just here to answer some test questions, okay? And so understanding for the test, it works. And Bob then, he can take his money, he can mix it around, whatever, and he makes money. But those taxes, the IRS tries, and they just bounce right off because it's in that tax bubble. That's what that insurance provides, all right? And then at some time, Bob's going to say, okay, you know what? It's time for me to start taking income out. And so I've got several choices that I can make getting my money out. Now once the money comes out, then it's no longer inside the bubble. So now, see, that's where Bob's going to see tax, at least on a portion of his funds, is right there, a portion of his income. So let's go ahead and look a little bit more in detail at these things, okay? They're insurance products, separate accounts, right here. It allows choices for flexibility of investments. The owner assumes market risks, because see, if it goes into the general account, the insurance company is saying, we will pay X%, and if we don't make that, well, we're still going to pay it because we said it in a contract. Here it says you're going to get what you get. So Bob is assuming market risks. Does have that tax-deferred growth. It's not tax-free because there is a payday for the IRS over here, okay? If you have a withdrawal, then it's taxed as ordinary income on a last-in, first-out basis. Now this is where you may see a question, okay? So basically, let's go ahead and look at how this works, okay? I put in $100,000 into variable annuity, and then it grows by $20,000. And so what I do is that I take out $30,000. Well, I start at the top and I work my way down, so I'm going to take this $20,000. This $20,000 has not been taxed, so that will be a taxable amount. Okay? I'll pay tax on that. But this, assuming that it's not inside a retirement plan, which you put a further bubble around that, and the outside bubble rules are what's going to determine what your taxation looks like. Well, in that case, it would be the retirement plan rules you need to look at. Let's keep it simple. Let's say it's just something that I did just with plain old vanilla money. I got to take $10,000 off of here. That's my $30,000. This is no tax. Because see, I actually paid tax on this part of it. There's my original principal right there. And I paid tax on this part of it before I put it in. That had to be after-tax dollars. So I get a mixed stream coming out, but it's going to be last in, first out. In other words, the earnings are taxed first. In other words, it's more beneficial to the IRS to do it that way. All right, so it's taxed as ordinary income on withdrawals. You get a blended stream of taxable and tax-free income on, there's this word, annuitization, okay? Ation is the process of. Eyes, see I'm reading it backwards. Eyes means to turn into, and then annuity. So it's annuityization. Annuity means a stream of payments. Yeah, that's the ultimate goal of these things, is to provide a lifetime stream of payments of income that the person cannot outlive. Yes, I know there are a lot of folks who use them for different purposes. We're taking a test. For test purposes, a lifetime stream of payments that you can't outlive. What's going to happen is that let's redraw this, okay? Because now I'm going to go back to the blue because see, on the green, I was talking about a one-time withdrawal. Now I'm talking about annuitizing, and so I have X amount of earnings that have not seen taxes, Y amount of principal which have seen taxes already, when I turn it into that monthly income stream, I'm going to draw from both of them every month. This is going to be taxable. This is going to be no tax. Okay? Until such time, but we say we can't outlive it. What if I live long enough that the first month I take that, and the next month, and the next thing you know, boom, I've depleted that. Well, then all of a sudden, since I've depleted my after-tax dollars, now I'm going to start paying tax on the whole thing, okay? But like I say, it's that blended stream. If we annuityize it, turn it into the stream of payments. Somewhat rigid and illiquid. You do make a long-term commitment on these things, all right? So what does a person have to have before they start looking at this? Cash reserves. I've seen questions that said, which of these is the least suitable for a variable annuity? And I wouldn't have sold them to any of them. But the answer was the guy who didn't have adequate cash reserves. Always go to cash reserves first. If you don't have cash reserves, you're not going anywhere else, okay? Index annuities or equity indexed annuities, terms are kind of interchangeable. They'll do this up to a degree, okay? Basically what they do is that they provide a participation in an index, and it's kind of a, well, here, let's just, we've got this down. Let's go ahead and just draw up what we're talking about here. Okay. So basically with an equity indexed annuity or an index annuity, what you have is that you have a certain base level that the insurance company will pay. This is what you will get. Then, if the market, whatever index it's tied to, performs at a certain rate, you'll get X%, it's in the contract, of the market action up to a certain cap point. So if the market does this, then basically what's going to happen is that you're going to do, because of the fact that you're getting a certain percentage of it, you'll start out here and you'll okay, imagine that that's an X% difference, okay? The thing is that once it goes up over the cap, then you'll actually, as it implies, cap out right there. Okay, so that's an equity indexed annuity, just another kind of a variation, a cross between a fixed and a variable annuity. It does give you participation, okay? But like I say, it has a minimum guarantee. A lot of times they'll have a cap on them. But again, it's another long-term commitment, so keep that in mind. Look for that suitability. All right, I'll tell you what, let's go ahead and take a break here. We'll come back then and wrap up on this particular section and then start going into some of the recommendations for various strategies. We'll see you in a little bit, and appreciate it very much. Thank you.